Hello everybody, and welcome to How to Never Lose in the Forex Market Again. This is an introduction to my mathematical method for eliminating monthly net losses in your Forex game. See, the truth is that many people lose in the Forex market. The failure rate is 90% to 95%. Those are the figures out there. And the chances are that you will fall within that 95 to 90% of total people who lose if you do not have a reliable tool to guide you along your way. So whereas many people charge a lot for courses that can help you, you are going to learn exactly how to eliminate monthly net losses in your Forex game for free. That is what this whole presentation is about. So I would like you to pay rapt attention and take away all distractions. For example, you may put off your phone or turn off notifications, and if you need to take a pen and paper up, you can do that so you can take notes, because I'm going to break down to you how you'll never have a negative month in your Forex game again. You have to remember that maths cannot lie. It's mathematical, and it's all about numbers. And so that is just exactly what you're going to have in the following presentation. Now, the beginning part of this presentation is going to contain things that people who are not used to the Forex market need to know before they get into the system. But if you already understand the concept of peeps and lot sizes and all of that, then you don't need to watch everything at this beginning part. You can just skip forward until the part where we get to the actual system that gives you the monthly profit. And I'm going to put a note on the website, below the video, where exactly in the timeline you can find the real meat of this video. That is the beginning of the actual system. For the rest of you, you can continue listening as I break down how to mathematically eliminate monthly net losses in your Forex game. So for us to continue, and if we have to understand this, we have to understand the concept of lot sizes. The lot size actually refers to the what would I say now? The amount of stake you're putting into your trade, the weight of the stake, or the volume of the stake you're putting into your trade. Imagine you are in a casino and you want to, stake, you want to bet. If you're betting $10, you're not going to earn so much. But if you're staking, say, $100,000 or $1 million, then you stand to win a whole lot if you win. But conversely, you stand to lose a whole lot more if you stake a whole lot more. So that's the way it works. You use small lot sizes and you stand to gain a little if you are right in your trade, but you also stand to lose little if you're wrong. And then if you stake big amounts, you win big, but when the losses come, you also lose very big. So lot sizes refer to how much you stake and they determine how much you lose. It refers to how much you stake. It will determine how much you gain and how much you lose. Now, lot sizes can be broken down. There's a way they're broken down mathematically when we use them in the Forex market. One lot size is referred to as one standard lot. One lot is referred to as one standard lot. That's what it's referred to. So when somebody says one lot, they really mean one standard lot, and vice versa. But you will hear people say one lot because they don't want to have to say a mouthful when they're referring to one lot. So one lot is the same thing as one standard lot. So one lot can be broken down into 10 parts. And it means that one lot is made up of 10 mini lots. So what it means is that if you divide one lot by 10, you have 1 mini lot. So 0.1 lot is 1 mini lot. 1 mini lot is 0.1 lot. 2 mini lots is 0.2 lots. 3 mini lots is 0.3 lots. 4 mini lots, 0.4 lots, all the way to 9 mini lots, which is equivalent to 0.9 of a standard lot. And of course, 10 mini lots is equivalent to 1 full lot. So that's the breakdown of the lot, the standard lot. And as a matter of fact, 1 mini lot can further be broken down into micro lots. So if you divide 1 mini lot by 10, you have 1 micro lot, which means that 1 micro lot is equal to 0.1 of a mini lot. 2 micro lots is equal to 0.2 mini lots. 3 micro lots is equal to 0.3 of 1 mini lot. 4 micro lots is equal to 0.4 mini lots, and 9 micro lots is equal to 0.9 mini lots. Apparently, 10 micro lots is equivalent to 1 full mini lot. So that's it. Now, I'd like you to understand the financial implication of these lot sizes when you trade. Typically, when you trade with one standard lot, when your stake is one standard lot, when price moves 1 pip in the direction you have said price is going to go, you earn $10. If price moves, let's stick to 1 pip for now, because that's the basic, that's the smallest amount of movement that we're expecting. Is a standard, measure of movement. So let's stick to 1 pip. So if you're trading with one full lot, one standard lot, you stand to gain or lose $10 per movement in price. That is $10 per pip movement in price, and we'll get to that, what 1 pip is. But if you are trading with 2 lots, you stand to gain $20 or to lose $20 per pip movement in price. So, because 1 mini lot is 1/10 of 1 lot, what you stand to gain or lose when you're using 1 mini lot is just $1 per pip. A lot smaller than what you stand to gain or lose when you're trading 1 full lot. And if you're trading 2 mini lots, you stand to gain or lose only $2 per pip, because 2 mini lots is 0.2 of 1 lot. If you're trading 3 mini lots, you stand to gain or lose just $3 per pip, because 3 mini lots is 0.3 of 1 lot. And with 4 mini lots, you stand to gain or lose only $4 per pip, because 4 mini lots is 0.4 of 1 lot. The same thing with 9 mini lots. You stand to gain or lose $9 per pip, because 9 mini lots is 0.9 of 1 full lot. Of course, if you're trading 10 mini lots, it means you're trading 1 standard lot, which means you stand to gain or lose $10 per pip. So that is how it works when you are staking or trading. When you trade, you use lot sizes. The lot size determines or at least specifies the volume that you're staking, how much you're staking in that very trade, and that determines how much you're going to earn or possibly lose. So let's look at the money implication of the micro lots, because we've seen the money implication of the mini lots and the standard lots in this chart. Standard lots here, mini lots down here. So let's see the money implication of trading micro lots. Because 1 micro lot is 0.1 of 1 mini lot, and 1 mini lot represents the possibility for profit or loss of just $1 per pip. Because of that, 1 micro lot, which is 1/10 of 1 mini lot, represents $0.1 in potential profit or potential loss per pip, which is 10 cents. And because 2 microlots is equal to 0.2 of 1 mini lot, 2 microlots represents 0.2 of what 1 mini lot represents, which is just 20 cents, $0.2. And so the same calculation goes all the way down here, where we have 9 microlots representing a potential profit or loss of $0.9 per pip. And then if you're trading 10 microlots, it means that you're trading 1 mini lot actually. And so your potential for profit or loss per pip in any trade you're using 1 mini lot in is just $1 per pip. So when you're trading one standard lot, you stand to gain or lose $10 per pip. When you're trading one mini lot, you stand to gain or lose $1 per pip. But if you're trading one micro lot, you stand to gain or lose 10 cents per pip. I think it's understood. And it's because one mini lot is 1/10 of one standard lot, and one micro lot is 1/10 of one mini lot. So now there's a way we express lot sizes. In these past few slides, I expressed them in as fractions of the standard lot and of the mini lot, but in reality we do not express it exactly like I did. If you observe here, everything here is expressed as either one lot or a fraction of one lot. Either one lot or a fraction of one lot. But over here, sorry, I think I'm mixing up the slides. Cool. But over here, one micro lot is expressed as a fraction of one mini lot. And now that is what is not really done. When we are expressing lot sizes, everything is expressed as a fraction of one standard lot. So what we have is that we're not going to have micro lots. We're not going to have micro lots expressed as a fraction of mini lots. Micro lots are not expressed as a fraction of mini lots. Everything is expressed as a fraction of the standard lots. So, excuse me, what we have is that one lot is equal to one standard lot, two lots is equal to two standard lots, three lots is equal to three standard lots, but one mini lot is 0.1 of a standard lot. 3 mini lots is 0.3 of a standard lot. Now, one micro lot is 0.01 of a standard lot. It's expressed as a fraction of the standard lot. It is 0.01 of one standard lot because it is 0.1 of the mini lot, which is 0.1 of one standard lot. So that is something that you have to know. You cannot express the micro lot in any way other than as a fraction of the standard lot. And so that's how it is. As you can see here, 3 micro lots is 0.03 of a standard lot, and so on and so forth. The bottom line is everything is expressed as a fraction of the standard lot or in standard lots. So now let's look at the concept of the pip. I mentioned the pip before, and where did I mention it? I mentioned it when I was looking at the money implication of trading different lot sizes. I said, okay, when you're trading one standard lot, you stand to gain $10 per pip. when you're trading one mini lot, you stand to gain or lose $1 per pip, and so on and so forth. So, what is the pip? Now, to understand that better, let's go straight to the charts. So we have to come straight to the charts to fully understand what a pip is. And this is the British pound versus the USD pair. That's what we have here. And I'm going to turn these candlesticks into a line graph. I already did that before starting this part of the video. I want to do it again so you can have the benefit of seeing how that is done. So I've done that now. And if you look at this closely, you will see that you'll observe that this is simply, all you're seeing here is simply a representation of what price is doing over time. Because on the horizontal axis, if you observe closely, you see that it is the progression of time. And on the vertical axis, you see that the calibration you see here is just price. So if we follow price over the progression of time, at the far end of this crosshair is marked what price is, what the exchange rate is at each point in time, so that we can see what price is doing at each point in time over time. So that is just what this chart is all about. So the tool I'm using is the crosshair, and it helps us to mark, to see exactly what price is at each point in time. If you follow this crosshair all the way to the right, you're going to see a value. If you just follow it with your eyes all the way to the far right, the value you can see there is 1.26053. And if you follow it all the way down to the bottom, you're going to see that the time at this very point where that crosshair is, where the intersection is, the time is 1300 hours. That is 2018, 12/11, 1300 hours. In other words, the 11th day of December 2018 by 1300 hours. What it means is that at that exact hour, the exchange rate was 1.26053. That's what it means. And it was 1.26053 what? It was $1.26053. It means that at that point in time, it cost $1.26053 to buy 1 British pound. And how do we know this? It is because down here in this currency pair, the way it is quoted, currency pairs always come in pairs. That's why they're called currency pairs. The currencies always come in pairs. So the way it is displayed here is the British pound comes first, the USD comes second. So the currency pair that comes second in the rendition is the quoted pair. It's always the quoted pair. So we know that it is the USD that is the quoted pair. Sorry, I say quoted pair, I mean this is the quoted currency. It's a quoted currency, not a quoted pair. You see, so we know that it is saying, hey, this amount of dollars is what you could buy 1 British pound with. So, having said that now, what is the pip? Now, let us put our cursor right here. You can see that this is 14th of December 2018, 00 hours is midnight. And if you follow the crosshair all the way to the right, far right, you can see that the value there is 1.2656. Let me make a note of that. 1.2656, and we ignore the final digits. We only stick to the first 4 digits after the decimal point. Now, if price moves from 1.2656 to 1.2654, it will be said that price has moved 2 pips. If it moves from 1.2656 to 1.2655, it will be said that price has moved 1 pip downward. In the same vein, if it moves from 1.2656 to 1.2657, it will be said to have moved 1 pip upward. But what if it moves 1.2656 to 1.2659? It will be said to have moved 3 pips upward. So, what then is the pip? One pip is a change in the exchange rate of a currency pair equivalent to 1/10,000th of the currency in which the rate is expressed. So in other words, when price moves 1/10,000th of $1 in the case of the British pound USD, we say price has traveled 1 pip. So it has to move 0.0001. That is how much change has to happen in price for you to say there has been a change in price equivalent to 1 pip. So so price can move 2 pips, 3 pips, 10 pips, 20 pips, as you can imagine. So right here, we saw that price was at 1.2656. Yes, 1.2656. But somewhere around 10 a.m., price was at 1.2590. So price had traveled many pips. So we're going to calculate exactly how many pips price had traveled downwards on account of this movement between 00 hours on the 14th to 10 hours on the 14th of December. So what we're going to do is we're going to simply subtract 1.2590 from 1.2656. So here we go, 1.2656 minus 1.2590. So price has moved 66 pips because this is 0.00001 times 66. Price has moved 66 pips in that situation. So there's something you have to understand about this. It is true that 1 pip is equivalent to a change in the exchange rate vertically, upward or downward. A change in the exchange rate of any currency pair equivalent to 1/10,000th, which is 0.0001 of the currency in which the rate is expressed. It is very true. But this is true when it comes to all other pairs except the Japanese yen pairs, because with the Japanese yen pairs, the Japanese yen is always the quoted currency, and so when it comes to the Japanese yen pairs, 1 pip is equivalent to a change in the rates of a currency pair that is equal to 1/100th of the Japanese yen. So a pip is a change in the exchange rate of a currency pair equivalent to 1/100th of the Japanese yen. So that's the distinction. When it comes to other pairs, when price moves just 0.001, which is 1/10,000th of the quoted pair, 1 pip has been traveled. But when it comes to the Japanese yen, price has to just move only 1/100th. And boom, we say price has moved 1 pip. So it's all about pips. You understand everything now that is needed for us to go into the real mathematical calculation. But just before that, you're going to understand, you're going to first be introduced to the concept. When you're doing math, you understand the concept before you go into the numbers. So that's what is going to happen next. So some of you might have heard about the martingale system, and that is a system I'm going to show you. And before you say, oh, the martingale, you have to understand that many people consider this a killer system, and many, well, not many, although the numbers are increasing as the days pass, a few consider it a winner system. And now, let me tell you this. The thing about the martingale is, it reminds me of human history. When there was a time in our history when if you wanted to sink in the ocean, if you wanted to sink in water, there are 2 things that could guarantee your sinking: stones or metal. At that time in human history, nobody knew how to make, in fact, I don't know if they were even thinking about it, how to make metal something that can help you float. I don't think they were thinking about it. Everyone knew that, okay, you can use metal for all kinds of things, but if you want to sink, then have a lot of metal on your body. But along history, somewhere along that timeline, someone discovered how you can actually turn something that should be a sinking device into a floating device. And today we have gigantic metal objects, metal vessels, carrying huge amounts of people and very humongous amounts of cargo, crisscrossing our seas, across our seas and our oceans around the world every single day, every single minute. In fact, the world depends on these metal ships for a huge amount of its international trade. So that's the same thing with the martingale system. When you don't know how to use it, it is something that will surely make you sink. But when you know how to turn it into a floating device, then it makes you float upon the deep oceans of the Forex market. I don't want to overstress this point I'm making here right now, but it feels very sweet to me actually, because right now, while people are floating, cargo is being moved around the world as we are speaking right now on ships. Metal can still make you sink, whereas people are depending. Our trade and everything is dependent on these metal ships, right, carrying cargo. Metal still makes you sink. The only thing is that these metals have been crafted into powerful boats, stable boats that you can rely on. So that's what we're going to do. We're going to see how we can craft something stable out of the martingale system that will float you through your Forex game. There are only 12 months in a year, and if you can be profitable every month in the year, then you are a winner and among the top 5 who come out profitable at the end of everything in the Forex market. So I have actually come across 2 versions of the martingale system so far, and one is from Wikipedia, which doesn't seem as comprehensive as the other one that I found. It says, a martingale is any of a class of betting strategies that originated from and were popular in 18th century France. The simplest of these strategies was designed for a game in which the gambler wins his stake if a coin comes up heads and loses it if the coin comes up tails. The strategy had the gambler double his bet after every loss, so that the first win would recover all previous losses, plus win a profit equal to the original stake. Now, so that's the concept actually. and we better just talk about it right away. The idea is that when you have, let's say you're in a casino, because that's where it evolved from, the gambling houses, and you're betting on the toss of a coin, instead of you to bet on heads now and on tails later, you just forget about all that. Choose one, choose heads, for example, and bet on heads only. The thing is, if you start with a $1 stake, if you lose, you double your stake and make it $2. If you lose, you double your stake and make it $4. What's going to happen is that eventually it must turn heads. And when it turns heads, because you're always doubling your stake, you're going to cover up all your losses plus what you would have won if you had won the first time. So that's it. And there are problems with this concept which you're going to see. These problems, of course, will not affect those who look at my or should not affect those who have my system. So the second version of the origins of the martingale, it speculates that the origin got its name from someone called John Martindale, who encouraged players to use the double-up betting system in order to be able to prosper from their losses whilst they played at his casino. It's also widely accepted that this betting system inherited its name from a distortion of John Martindale's last name, even though it remains unsolved, the actual origins of the name. And if you look at the name, the only difference between Martingale and Martindale is that Martingale has G in place of D in the name Martindale. So that's that. So the story goes on to say that over 100 years after the martingale system was created, there was somebody called Mr. Charles Wells, who successfully beat the casino when he applied the system to a game of roulette. You see, what he did was that he successfully beat the casino by breaking the bank 12 times within just 3 days in Monte Carlo. Monte Carlo is in France, and it's a very reputable gambling city in France. Apparently, it has been a reputable gambling city before even many of our fathers were born. So, all of our fathers, by the way. So, he made a win of 1 million francs, which he surprisingly managed to generate from an initial amount of 4,000 francs. And the win was a very groundbreaking one within casino circles. In other words, it was sensational at the time. We're going to skip this slide. It's not too necessary. So now, this is the thing. This is the thing. We're getting deeper into the whole thing now. If you remember, when we looked at the charts, let me go back to the charts. You see that price never goes in one direction steadily. It goes in whatever direction it's going. Here, it's going up, but it goes up, kind of flattens out, goes up, then goes down, then goes up, then kind of loses steam, goes up, loses steam, goes up, goes down, goes down, goes. That's just what it does all the time, all the time. So, look at this again. You can see zigzag, zigzag, zigzag. It's going down, but it's going up and down, you know. So, that is how price moves. And so, when you are trading, the similarity between the gambling house and the forex market is that, let's say, you're betting on, let's say, when you're gambling, the similarity between gambling and the forex market is when you're betting, there are just two outcomes, right? Heads or tails, right? But in the forex market, it's the same thing. There are only two outcomes. Price may go up or it may go down. And if you're buying, you are betting on it going up. And if you're selling, you're betting on it going down. You get. So that's why it is very similar, and you can apply the martingale system to the forex market. The only thing is you must not apply it just as it is presented. Always double your money and all that stuff. You see, there's a way to do it that works. So this is the actual concept. We said we're going to choose only one position, and now let's assume we're choosing heads. Let's assume we're choosing buys, and we at this point we choose a buy. We buy here. Unfortunately for us, price goes down and we lose our money. We thought we were going to make money, but no, we lose the money. Price goes down. Instead of us to sell because we see that price has started going down, we don't sell. We still buy again. Just like what we explained. You go ahead again. So we buy again. And instead of price going down as we wanted it to go down, it went up. Sorry, that's my mistake. Instead of price going up as we wanted it to go up, it went down. Of course, you could see the zigzag on the chart. It didn't go down all together, just all at once. It went up a little bit and we were happy. We thought it was going to make us profits, and all of a sudden, boom, down. We lost again. So we don't say, hey, we've lost when we took a buy position, we lost, so let's take a sell. We don't do that. We buy again. And then when we buy, let's say in this case, we bought here, thinking price would go up. And sure enough, it did just a little bit. And then, unfortunately, it went down. We buy again. It didn't even go up much. It went down. And this time when we buy, it goes all the way up here. By the time it gets up here, what really happens, and this is mathematical, is that every loss you have incurred, all the way from here down here, every time you were doubling up your stake, or every loss you incurred will be recovered in one move, plus whatever profit you would have made if this first trade was right. That's how it works. So, let us dive right into the system, how it is done. First, I'm going to show you the basic way in which it is done, the simplistic approach. And you are going to spot by yourself a few things you don't like about it. It is profitable, but you're going to spot something you don't like about it. If you don't spot it, I'm going to spot it. I'm going to point it out to you. So, here you have the trades. I've already put them out here. I've put the lot sizes that you trade when you enter these trades here. You double your lot sizes, and this is why we had to go through the lot size and the money implication associated with trading these lot sizes, because I've also fixed what you gain or what you lose in case you gain or you lose in any of these trades. So that's what I have done. So let's start from the beginning. Let's say you enter a first trade and you start with a small lot size because you want to be safe. You start with 0.01, which is 1 micro lot. And if you remember, we said that 1 micro lot represents a potential in profit or loss of 10 cents per pip. And with this spreadsheet, we are saying that in every trade you are targeting 10 pips of profit and you have 10 pips of stop loss. And for those who don't know what a stop loss is, the stop loss value is the value that you fix on your trade so that if price goes against you, that number of pips, you exit the market whether you are there or not. The platform just exits you out of the market, so you can never lose more than that. That is what your stop loss value is, and it's represented in pips. So what you have here is 10 pips. The take profit is just the same thing, only it's in the profit direction. So the take profit is the same thing, but it's in the profit direction. Now, you have profit targets of 10 pips and stop loss of 10 pips. So, first trade, if your first trade was profitable, what are you going to get? You're going to have a net gain of $1 because you made $1 and you had no loss. The first time The first time you shot, boom, you scored. Price went in your direction. You have $1. But in case you said you're going to buy, you're going heads, and price didn't go in your direction, price went down instead. So your first trade, you lost. So it was in the second trade you made money. That means that, using an example, you bought here, you lost, but when you bought here, price actually went all the way up and you made money. What you're going to have is, your first trade, you've lost $1 because you were trading with 1 micro lot. Stop loss is 10 pips. You lost $1. But on this second trade, you're using 2 micro lots, and 2 micro lots represent, if you remember, 20 cents per pip. So 20 cents times 10 pips gives you $2. So guess what? You made a profit of $2, but from the previous trade, you lost $1. So your net gain is $1. But let us say that you made your first trade, you lost. Second trade, you actually lost, and it was at the third trade that you made some money. Price actually went up and you made money. What you have in that situation is that here you have doubled your lot size again, and you're trading 4 micro lots. 4 micro lots times 10 pips, which is 40 cents, which 4 micro lots represent in potential profits or loss, times 10 pips gives you $4. But the previous losses are $2 and $1. So that's $3. So your net gain is $1. By the way, I'm going to send you this very PDF in your email since you subscribe to see this video, if you subscribe to see this video, so that you can look at it yourself. But if you follow through, you find out that whatever you stake, when you keep on doubling your stake, your cumulative loss keeps on increasing. And I've calculated it right here, the cumulative loss. For example, the cumulative loss on this level is 3, here it is 7, here it is 15. So the cumulative loss keeps on increasing, right? You end up making a profit. But guess what your net gain is? What it remains? It remains $1 no matter what. So you see how undesirable this is. It means you stake so much of your money, as the trades progress. And guess what? You're making only $1. That's not a smart decision, because let's say you have a $1,000 account, right? By the time you are on the 11th trade, all your money is gone. You've lost all your money. And this brings us to the fundamental flaw of the martingale system. The flaw is this. Theoretically, we know for sure that if you toss a coin 10 times, you are supposed to have at least 5 times heads. But practically, we know that we do not know how many times you're going to have tails before you have heads. So in other words, we don't know how long of a losing streak you're going to have before you have that one win that balances things out. And guess what? We know you don't have an infinite amount of money. So it's possible you have nine tails before one head. It's possible. Anything is possible. And so you can easily lose your account. So those are the flaws with this. But I'm going to show you something better than this in an Excel spreadsheet that makes this a whole lot better. So that as you are increasing your stake, right here, your net gain keeps on increasing, so that if you trade 6 times, hey, you have a big amount of money here. Your net gain commensurately increases with the amount of stake you have, and that's a much better and much more desirable approach. So, what is the approach? We're going to make a little change, and it's a small change, but it results in a very nice improvement in the outcome. And the small change is this: whereas in the previous spreadsheet we had a profit target of 10 pips and a stop loss of 10 pips. Here we have just changed one thing. We have made the profit target to be 15 pips and the stop loss to be 10 pips, and it ends up in a very nice and big difference in profitable outcome. And I think in my mind this goes back to the butterfly effect, which if you're not familiar with the butterfly effect, simply come over to Wikipedia, this very link, and read about it. But I'll simply briefly say what the butterfly effect tries to explain or put forward. It's trying to say that little changes in the factors that determine a later outcome can result in huge differences in that later outcome. So minuscule differences in the factors that affect the outcome right now can result in huge, very big differences in the outcome later. And that's, in my opinion, is what is going on here. So let's take a look at it now. Only thing that's been changed is profit target. So our first trade, we have in the event that we make it in our first trade, we have a profit of $1.5, because instead of us targeting just 10 pips as profit target, this time we targeted 15 pips, and one micro lot represents 10 cents in potential profits or potential loss, and we multiply that 10 cents by the 15 pips of profit, and that gives us $1.5. And so we have no loss here in this scenario. But in the event that we had to take a second trade to make a profit, it means that we're going to lose our first trade, and we're going to lose $1 because one micro lot represents 10 cents in potential profit or potential loss, and our stop loss was 10 pips. Gives us 10 cents times 10 gives us $1. That's our potential, but that's our loss in this situation. However, we have doubled our lot size, and because we've doubled our lot size, one pip represents 20 cents in potential profit and potential loss. This is 2 micro lots, remember? And so we multiply 20 cents by 15, because one pip represents 20 cents in potential profits and potential loss. So 20 cents times 15 gives us $3 as opposed to 2, which we had here. And so what's our cumulative loss? Cumulative loss, hey, first loss, $1, right? Cool. So $3 minus $1 gives us $2. That's our net gain. But let us say we have a different scenario where we lost these first 2 trades and we had to enter a third trade to make that profit. Hey, what it means now is that our cumulative loss is $1 for the first trade, $2 for the second trade, which makes us $3, right? So cumulative loss is $3 right here. But because we have doubled our lot size to 4 micro lots, it means we're making 40 cents per pip. And so we multiply 40 cents times 15. That gives us $6. So here we multiply, we subtract cumulative loss from our profit. Our net gain is $3. The same thing happens here. We multiply 80 cents. In the event that we lost all these 3, we double our lot size again. So we're looking at 80 cents in potential profit per pip and 80 cents in potential loss per pip. But now when we make a profit here, so we say 80 cents times 15, that gives us $12. Our cumulative loss is 4 plus 2 plus 1, which is 7. So 12 minus 7 is 5. So we see that whereas in this scenario, whatever happens, no matter how we increase our lot size and no matter how much loss we are, how much cumulative loss we are accumulating, we keep on earning just one miserly dollar. But here, as the trades progress, if we have more trades, we keep on getting more and more. As a matter of fact, by the 10th trade, we're making $257. Now compare that with how much are you making here? $1, whatever. You see, so you see that it is so much better. You're making so much more. So this is very nice. You know, as a matter of fact, if this gets to the 12th trade, you're making $1,000. But don't just rejoice yet. These numbers look very good, but I'm going to show you other numbers that you might not have seen that should make you stop for a while. Like I said, you don't have to, I don't know if I mentioned it, but you don't have to rush to try and implement this. Let me draw the curtain a little wider so that you see more numbers that you might not have seen before. First of all, you see that simplistic approach that we looked at first, where you're earning just $1, whatever the case. Let me just thrash it completely. Let me thrash it. Now, let me draw the curtain a bit further. Let me just reveal a few numbers that were not there before. Now, if we look at how much of your account is lost along the way, you see that when you start first, on your first trade, you don't lose anything. The percentage drawdown on your account is 0 because you made profits on the first trade. But in the second scenario where you make profits on the second trade, hey, it's still small. Third trade, fourth trade, fifth trade, sixth trade, it's only 3%. Seventh trade, only 6%. About eighth trade is 12.7%. Ninth trade, 25%. 10th trade, 51%. So guess what? If it takes you 11 times before you make a profit, anytime that happens, guess what? You've lost all of your account because the percentage drawdown here is 102%, which translates to 1,023. So your account is gone. Boom. Never mind the fact that, it's only $1 you're earning here. So this is assuming you're starting with a $1,000 account. If you're starting with a $1,000 account, but if you have a $10,000 account, it's not so bad because, hey, it's very small amounts you're losing, along the way. The cumulative loss translates into very small amounts percentage-wise when it comes to the drawdown. And where you would have lost everything if you had only $10,000, you've lost only 10%. As a matter of fact, it takes up to 13 trades, which is not very... Well, it's possible. It happens. In fact, I've seen it happen many times. It takes up to 13 trades for you to lose up to 40% of your account. But guess what? In spite of all this, you're staking and losing, you'll have a net profit of, guess what? $1. So it's just crap. The only reason I presented it to you is so that you understand the workings, and I think it has served that purpose. So let's go over to this modified one here, where you're going for 15 pips of profit and your stop loss is 10 pips. And it looks very good because, hey, on your, I think that's your let's count this: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. On your 11th trade, you're making 513% in net gain. On your 10th trade, you're making you're making $513. On your 11th trade, on your 10th trade, you're making like $257. It's very nice, you know. Here you're making $129. It's beautiful. It's beautiful. It's beautiful. 9th trade, $129 net gain. So in other words, sometimes you may want it to proceed this far compared to this, $1 scenario. This is just crap. This is very good. But if you look closer, you find out that, hey, you were still suffering the same amount of percentage drawdown. So in other words, whereas on this 10th trade, I believe that's the 10th trade. Okay, that's the that's the 10th trade. You're making, say, $257 of profit, and you're happy about that. That is on a $1,000 account. You've lost 51% of your money in the process. Of course, when you make $257, you've gained everything back. You have no loss. This is just, the drawdown refers to the loss on the way to profit. You get, so it's not as if you end up with a 51% loss. It means that on the way to profit, your cumulative loss summed up to 51%. But guess what? Anytime this moves up to an 11th trade, if you had just $1,000 in your account to start with, you're going to lose all of your money because your percentage drawdown at that point is 100%. And when your percentage drawdown is 100%, it means you've lost your account. You have nothing to trade again. You've lost it all. It's called a margin call. You see? So that's why it may look good, but hey, take a look at this. If you have just $1,000, you're still in possible Forex mortal danger. Because that's mortal danger for any Forex account. So the only time it's better is when you have $10,000. Because guess what? At this point, you're losing only 10% of your account. That's fine. And it's not as if you lose it. You just lose it on the way to making like 5% profit total. So this is the loss on the way to profit. You see? So it's fine. It's fine. The only thing is that, hey, by the time you get up to the 12th, 13th, 14th trade, guess what? You're losing 80% of your account. And any system that makes you lose 80% of your account is not a trading system. It's not something you can count on. It should be thrown away. It's possible for this to happen doing just this thing I have explained here. So that is why I say this is good, but you should not use this, because I don't use this myself. So if I don't use this, but you can see how you can tweak this thing and make profits, then what do I use? That's the question. What do I use? What I use is a highly advanced version of these things you've seen here. I would say a highly advanced version of this whole thing you see here. And this version keeps the account very safe and keeps on making profits, whatever the case. It takes into consideration account size and just everything that you're supposed to take into consideration to create that floating vessel that I talked about at the beginning. And going forward, I'm going to show you how I came about that system, and how I was talking to my fiancée, how I don't want to give anyone the system, but I've decided, okay, hey, look, let me teach people this for now. So And the next part of this video, I'm going to show you exactly how I got to that part. I got to this system and why it works for me. It works not just because I know the math of it. There are a few things I had as an advantage that made these things work for me. And I'm going to break it down to you now. So this is a well-abridged version of the story of how I came to start to use a precisely and very well-engineered version of what I have just shown you, with specific rules for entry, the right account size, and the right pairs, and how I execute this further well-engineered system on 9 to 10 pairs at a time. Now, the right pairs is very important because not all pairs behave the same. All pairs have their unique characteristics. So in 2012, I was still studying to become a software engineer, and I came back from class and put on the TV, and I was watching Bloomberg News, Bloomberg TV. I watched a lot of it back then, and there was this news headline. The headline, and in fact, the actual story was that this programmer, Mr. Sergei Aleynikov, originally from Russia, had been released from jail after 1 year, even though he was sentenced to an 8-year jail term. He was released because his lawyer was able to prove that what he did not constitute clearly what do you call it now? Corporate espionage in the United States under United States law. So what really happened was this. He used to be an employee of Goldman Sachs, and he, as a programmer, used to write programs for the Forex market. He used to write algorithms for Goldman Sachs to use to trade in the Forex market. So in other words, he wrote Forex robots for Goldman Sachs. Apparently, the robots he wrote were profitable. I think it is a robot he wrote. It was profitable. Goldman Sachs actually claimed it made over 500 million for them. And when he was leaving, he took part of the code that he wrote for them. And Goldman Sachs said, "What? We're going to send you to jail for that. We are going to send you to jail." And so he was charged with corporate espionage, apparently, and he was given an 8-year sentence. But a year later, and this was making the news, hey, his lawyer found out there was a loophole. His actions could not be tagged corporate espionage, and the judge set him free. I sat down, watched that, and I said, yes, this is something I had been suspecting for a long time. That all these robots we see in the marketplace that cost $300, $400, those robots were not really worth that much. That if there were robots that made good money in the market, the stakes surrounding them would be much more than would cause the owners to invite the world to download it for $300 a piece. So at that point, I said, we're learning Java in class. If myself and my classmates were learning the MQL4 language, the language that teaches you, the language with which you write Forex robots, I said to myself, wouldn't we all be rich? And so I started my journey in 2012 to learn how to make Forex robots and to learn the MQL4 language. I made some success in 2015. I had a robot that did so well, but unfortunately, I couldn't lay my hands on the codes. And so, even up till today, I'm still trying to get that one I did then, but that's not an issue. Because in 2017, towards the ending, I took on another approach to the market and wrote a new Forex robot, a new expert advisor. That's what they are called, EAs. And that one turned out to be profitable. As a matter of fact, when I wrote it, an associate, I used to call him a friend who I've worked with Forex-wise for years, tried to steal it from me. but that's another story. So the robot I wrote has been profitable till date. Now, the robot I wrote actually, it's a robot that executes this my modified system. In other words, all the rules for my approach to the martingale system, everything has been programmed into my expert advisor such that it would do exactly what I would do if I was sitting in front of the computer every day trying to trade the markets. Now, the version I've shown you here is like basic, like crude. But you can see mathematically it works. You wouldn't want to try it with a $1,000 account, but you might want to try it with a $10,000 account. However, if any martingale series gets up to the 14th trade and it's negative, you're losing 80% of your account. And you cannot call any strategy with which you lose 80% or with which you could lose 80% of your account a good strategy. Even if you're losing 40% of your account, it's not so good, you know? So I would say that if you want to practice what I've shown you here, you need to have a huge amount of money, and maybe $50,000 would do. But I don't want to be the one to give you that advice, basically because I have given you here the basics. Chances are you have $50,000 in your account, you will keep on making profits if you do what I've shown you here. However, I won't give you that advice. But if you go ahead to do that, you probably will be in profit. But I will not advise you to do that. So the question is, what if there's a way to trade with $1,000 and have a drawdown that is far less than this, so much less than this? What if? Now the answer is there is. My system makes that happen for you. Now, let me go on to something else. If you want to trade my system, or many systems actually, manually, there is an issue that rears its head. The issue is that you have other things to do. You have to go to work. You have to pick the children from school or maybe take them to school. You have to go to church. Sometimes you want to watch a football match. You want to read a book. But guess what? The market is on. You know, it doesn't stop from Sunday night to Friday night. It's on. So you could miss, as a matter of fact, you will miss certain opportunities for profit. And you could, especially with the martingale system, end up with some losses because you were not there to place the trades you were supposed to place when you were supposed to place them. So you can end up with a tinier profit than you were supposed to make, or you could end up breaking even, or you can end up with a small loss after the whole month is over for all of your efforts. In fact, you can end up with a significant loss, like 10%. And why would you work so hard to end up in a loss? So those are the issues with trading manually, as most Forex traders are finding out. It's just not so easy because they have other things to do. So if we go back to this story, when I wanted to record this video, I decided to go and research it. As you can see, I got the images from the internet. I knew it to be on the internet because everything is archived nowadays. So I went and searched it and I found it. But actually, this is where I found the news. This is where I met it in 2012. This is when it actually happened. I wasn't aware of it 2011. But when I tried to look up this event, this happening, I found out that something really terrible happened afterwards. And this is what happened. In 2015, he was convicted again. You see, Goldman Sachs would not let him go. Between 2012 And 2015, they spent years researching and looking for laws that would find him guilty. Goldman Sachs, multi-billion-dollar company, this is just a programmer. They said they found it worthwhile investing in trying to make him guilty for 3 years, and they succeeded. So, what did it tell me? It told me further that this represents the real stakes behind any profitable Forex robot. Because you have to remember, it's money, and people get emotional when it comes to money. People claw and scratch and do all kinds of things. So, I know also that they must have done it because they have other programmers in their employ and they want to make an example. They want to make other programmers know that you can't do this and go scot-free. This is the viciousness with which we will go after you if you take any of the codes you make while you're with us when you want to leave. So I think I understand that. However, it made me decide that I wasn't going to sell my EA or give it away. So I decided to do something else for you, because I want you to have the full benefit of my software without having to pay the kind of money that you need to pay to benefit from it, because clearly it's going to be a lot of money. So if you don't want to require $50,000 to start, if you want to be able to start with just $1,000, if you don't want to have to stay glued to your computer while trading, if you don't want to be making only 3% per month because you can manage to keep on top of only 3 pairs at a time, with my software, it's a software, it can track 9 pairs, 10 pairs at a time. So if you don't want to be making only 3% per month because you can manage to keep on top of only 3 pairs at a time, if you don't want the risk of making only 1% per month or less for all of your efforts simply because you missed the vital counter trade due to perfectly normal human activities like going to bed at night, being at work, or even driving home, then this is my offer. Yes, I have an exquisite offer. I am going to show you everything about my own implementation of the martingale system that makes it into a steadily winning machine, a floating ship rather than heavy sinking metal. I'm going to show you my method that will cause you not to spend or not to need $50,000 to start, but instead just $1,000. So you're going to be able to start with $1,000 and not see any of the kind of drawdowns you saw in the Excel spreadsheet. I'm going to deploy my software to work for you so that you enjoy the full benefit of the software without having to pay anything close to its real value. For 15 full months, my software will work for you, banking profits for you every month, whether you are busy or not, whether you travel for work or holiday or not, and whether you actually know how to trade or not. My software will faithfully work for you every active trading hour of every week until the 15 months are over for a ridiculous fee of 22,500 naira. Now, that ends up being a miserly 1,500 naira per month. First and foremost, I am giving a fast action bonus to the first 40 people to respond to this offer. To the first 3 people to secure a place among the 40 by paying their 22,500 naira fee, I will give a full 100% refund of their 22,500 naira fee, causing them to be participants in the program at a completely 0 naira cost. Now, I could easily say that the first 3 people shouldn't pay anything, but I don't want this to be given to freebie seekers, people who are just looking for something for free. So that's why I would require that you pay the 22,500 naira first, and then I will do a refund. I'll transfer the money back to you, and you'll be participating in the program for 0 naira. So to the next 17 to secure a place among the 40, I offer a 44% discount on their 22,500 naira fee, causing them to be participants in the program at the cost of 12,500 naira, which is equivalent to 833 naira per month. To the next 20 to secure a place among the 40, I offer a 22% discount on their 22,500 naira fee, causing them to be participants in the program at the cost of 17,550 naira, which is equivalent to 1,167 naira per month. To the rest, you get a zero discount. So don't be among the rest, because they get a zero discount, causing them to pay the full fee, which is 22,500 naira for access to my system for 15 months. Now, this is a very crazy offer, and it won't be there forever. I know lots of marketers say there's a deadline for this, there's a deadline for that, but they don't really have a deadline. For me, I do have a deadline because I know the value of what I'm giving out here. So I would encourage you to take it. There's a reason why you should take advantage, and I'm going to show you why I'll be forced to change things very, very shortly. Now, after 5 to 6 months of profits with me, I will show you how to run a Forex fund management business even if you do not know how to trade. I'll do this in my Forex Fund Manager Toolkit. This is a course that will be sold to the public for 50,000 naira per person. But if you're among this first 40, you get it for free. You don't pay anything extra for it. So only the first 40 to take advantage of this offer end up getting the Forex Fund Manager Toolkit for free. The rest pay 50,000 naira for it. So you have to understand that when you are being a fund manager for people, you are not going to take on a lot of the stress that many fund managers unfortunately put themselves through. What is going to happen is that my software, just as it creates profits for you, or it has created profits for you for 3, 4 to 5 months, my software is going to create profits for all of your clients, all of them, simultaneously, without you breaking a sweat. And so I'm going to make that offer to the public somewhere around March. No, somewhere that should be April or May. And when that is out, it will be sold to the public for 50,000 naira. But you here, my first 40, will get it at no extra cost to you. And so by March of 2019, we will be jacking up the price of this whole package to 50,000 naira. And this is the reason why. It's not just a threat. It's not an empty threat. It's not a threat in the first place, actually. The reason is that we will start selling to the international market, and they have more money to pay. And products like this that sell abroad, they are very expensive. In fact, you have to pay like, I think, $200 per month. You get, so we cannot be selling this to the international public, the international market for $300 a piece or $500 for the year, and then have them find out that Nigerians are paying like, say, less than $100. It's going to make us look bad, So when we launch, I think that's around March, we have to increase our price so that the disparity doesn't look too ridiculous, And if we advised, and I know 50,000 naira is still small, so we are very likely to take it above 50,000 naira. The only reason why we may not take it above 50,000 naira is, I know very well that the purchasing power in Nigeria is not that great like it is abroad. So that's why it might remain at 50,000, but that is not a guarantee. The only thing that's guaranteed is that the price will go up so that we don't look ridiculous selling this to the Nigerian public for less than $100 and then selling it to the international public for $300 to $500 a piece. So this is how to pay. Pay to Dafiri S. Irims, account number 0047053293, Bank Guarantee Trust Bank Nigeria PLC. When you have paid, send your payment details to payments@forexwealthsolutions.com. You will be provided the link for downloading the video where I reveal my full system, and will also be added to our closed Facebook group where I'll share all the value I come across and create with you to keep you on the winning edge in your Forex endeavor. So basically, in that group, you get every new thing that I get so that you stay on the winning edge. Basically, so you avoid being among the 90% or so that are perpetual losers in the market, and you stay among the top 5 or 10%. Many say it's 5% that are perpetual winners in the market. Now here's a recap of what you get. You get 15 months of my program Slaving For and Creating Profits for You while you go about your normal life. You get a 22 to 100% discount, and that's for the first 40 people that get on board. You get my Forex Fund Manager Toolkit when it launches. The price is 50,000 naira, but you get it for free. And this applies to you if you're among the first 40 to take this offer. You also get access to my closed Forex group on Facebook. You have access to my personal number, which you can call on specified weekdays within work hours for personal issues you may have with your Forex endeavor. And anyone outside the first 40 is exposed to the possibility of being forced to pay a non-negotiable fee of 50,000 naira for this package because the new price regime could take effect earlier than the set March date. Now, what I'll tell you is that even if you're not among the first 40, just go ahead and pay 22,500 naira because, as I've explained earlier, we are going to sell to the international community and we will be forced to increase the price at which we are selling to the Nigerian market just to save us from looking ridiculous. You get, I know that things are not so easy in Nigeria, so that is why I've decided to keep it at 50,000 naira against the advice of my associates. You know, they think it's stupid, actually, to be frank with you. They think it's stupid. Just yesterday, that was 2 days ago, I sat down with one of them and he's not in agreement with what I'm doing here at all. But I have my reasons and we'll just go ahead with it. We'll go ahead with it. But what I'm trying to say here is that if you're not among the first 40, please don't be afraid to pay 22,000 naira because we'll be forced to make it 50,000 naira when we are going to sell to the international community, as I have explained earlier. And ladies and gentlemen, this is the end of this presentation.